about 5 tax tips you can do now to reduce your tax burden for 2022. And burden is a good word. No one has ever told me they don't want to save money on taxes. Tax tips are always a good idea to consider in financial planning. And in fact, being tax aware is one of the big parts of financial planning anyway. So this is a big part of what we do for clients, and part that I actually love because I find it really interesting. There are all kinds of opportunities out there to reduce your tax burden and take advantage of almost like gifts that the IRS is giving you, but not everybody knows about them. Let's talk about these today. First off, let's talk about 2022. Why extra tax awareness could pay off in just the next couple of weeks before we exit this historical year. First off, the Tax Cuts and Jobs Act is set to expire at the end of 2025. Without going into a whole bunch of detail, what that means is that in 2026, we likely will see higher tax rates, as well as a change to the tax rules, the standard and itemized deductions, and a lot of other pieces. So might as well take advantage of lower tax rates now while they still exist, just for a couple more years. Next thing is inflation. Oh, ouch. Inflation has been real this year. A lot of people are feeling it. So anything we can do to save a few dollars, put a little extra money in our pockets, would be helpful and a welcome reprieve right now. Finally, in a year when stocks and bonds and just pretty much everything as far as investments is down, this actually offers opportunities that are easily overlooked by average investors. So don't let that be you. There are things that you can do now to make lemonade out of the lemons you may have been seeing in your investments. Number 1, tax loss harvesting. It's kind of like it sounds. You go in, you look for the seeds, you look for what has grown over the year, and you harvest it. But losses are the key point here. If you have a taxable investment account, so that's an individual investment account, maybe a joint investment account. I'm not talking about a retirement plan, like a 401k, 403b. Not talking about that right now. But an investment account. You probably have seen losses this year, but you can work that to your advantage. If you sell investments that are down, you can replace them with reasonably similar investments and then use those losses to offset the realized gains that you might have elsewhere. I know that kind of seems complicated. Basically, talk to your advisor, talk to your CPA about this idea. And it could mean that you can set yourself up really well with investments that will continue to grow, but taking the losses you've experienced this year to offset your taxes. You can also offset up to $3,000 of regular income, which is really cool. So you don't even have to have necessarily investment gains anywhere to help offset those losses. Talk to your CPA or advisor about that. It's kind of a cool trick. Number 2, what we want to talk about here is charitable giving. Very popular this time of year for a good reason, but being a little bit sensitive to how and when you do your charitable giving can help you and the charity. So this strategy isn't for everybody, but you could consider bunching. What that means is that if you make a large contribution in one cash contribution, let's say, at this time of year, instead of piecing out your contributions over several years, one large contribution could help you get past that standard deduction and get into itemizing your deductions, which could give you more leverage in your taxes, could give you a tax break. Again, not for everybody there, but if you are charitably inclined and you have the cash to do it, you could consider making one larger contribution and maximizing on that. The charity still gets the money you were going to give them anyway. If you have other questions about strategic philanthropy, you can also check out our blog. About this time last year, I wrote an article about some other ideas of how to give strategically. So check that out. Next, on charitable giving, if you are in your 70s, you are probably familiar with RMDs. If you turned 72 more recently or back in the past, the rule was 70 and a half. Either way, if you're in your 70s, you probably know required minimum distributions. What that means is if you got a tax deferred account like an IRA or a 401k, then the IRS is going to tell you, hey, enjoyed that tax deferral for a long time. You know, you're old enough now. Please take some money out so we can get our tax revenue. Actually, it's not a please, it's a requirement. So you have these required amounts you have to take out of your accounts each year. A lot of 70-year-olds that I know don't like this at all. So what can you do? If you're charitably inclined, once again, this is the coolest thing you can do. You can make that distribution and give it directly to the charity. It doesn't even really touch your hands. You don't pay taxes. Charity doesn't pay taxes. Win-win. Very cool, but you just have to classify it properly. So if you're subject to RMDs, ask your advisor about making a QCD, a qualified charitable distribution, to save on taxes. Pretty cool. No matter what age you are, tip number 3 is pretty awesome. Ride the tax brackets. So this means that you take a look at the tax brackets each year. They change every year. Take a look at 2022, which we've got. I know it's really small, but we've got right over here on the screen. Figure out about where you fall, where you think you will fall, whether you're filing single or joint, and see if you're near a bracket. If you are near the bottom part of a tax bracket, then you want to make sure that you prioritize the things that can move you down into this lower tax bracket. And if you're at the top end of a tax bracket, you want to prioritize things that help you to stay below and stay in the lower tax bracket. You want to avoid things that would kick you up into the next tax bracket. And we're going to talk about what are a couple things you can do to move and ride those tax brackets. But the first part is just being aware. Where are you? I've talked to clients sometimes that they're just solidly in one bracket. So yeah, do some things to help you out with your taxes, but it's not as significant as if you were near a bracket. You want to be super aware of that. So here's one thing that you could do. Now, if you're a salaried employee, this may not apply to you. But if you do freelance work, if you have a side hustle, or if you work for a company that has deferred compensation, you might actually consider deferring some income until next year. That might sound counterintuitive, but if you defer billing for your services maybe until January, you can lower what you're making in 2022. You're still going to make it eventually anyway. So helping to lower your taxes in 2022, maybe keep you in that lower bracket. And here's the other key. Income levels at specific tax rates are going to rise in 2023. So potentially this could give you room to earn more income taxed at a lower rate if you do that next year. So just a thought. Also, if you own a business, side hustle, do freelance, take a look at your business expenses now. Maybe think about making some purchases before 12/31/22 to claim as business expenses. Maybe you've been considering buying a computer or a new printer or something like that. Well, if you do that now, you might, again, ride those tax brackets. You might be able to keep yourself in a lower tax bracket, have the new shiny thing that you want, and help you with your taxes for this year. So be super aware of that if you are a business owner. Don't put that off until you're filing your taxes next year. Next, regardless of where you work, whether you work for a corporation or you do freelance, doesn't matter. If you have earned income, there's likely a retirement plan out there that you can contribute to and get a tax break. So think about maxing out your contributions to retirement plans. Now, a lot of people with a 401k or 403b with an employer match will say, yeah, I'm doing that. I've got my full employer match. Yay, but no gold star yet. To really max it out, know that the IRS limits are a lot higher than the employer matching limits. So for 2022, the maximum an employee could put in a 401k or 403b, $20,500. If you're over the age of 50, that goes up to 27 grand that you could put into a retirement plan. I know that's not feasible for everybody, but think about ways that you could increase it even incrementally. And that helps you, again, to report less income, which means you pay less in taxes. Pretty cool. Now, if you don't have an employer that offers something like that, 401k, 403b, you probably, as long as you have earned income, you probably still could do an IRA or a Roth IRA. And those limits are lower, but could still help you with your taxes. The maximum $6,000 if you're under age 50, $7,000 if you're over age 50. Now, quick caveat that a Roth is not going to give you a tax advantage this year. The advantage to the Roth is you have tax-free income later in life, right? So that's not going to help you reduce your tax burden today, but it is still a vehicle for retirement savings and planning, and will give you a tax advantage later. Your future self will thank you, as I like to say. So what this all comes back to, I know I've gone through a lot of concepts really quickly, but overall, the idea is to do some planning. The quote here, planning is so important. It is bringing the future into the present so that you can do something about it now, rather than looking back and saying, darn, I wish I had done so and so.